Now, this draws on some work by the very excellent Robert Shiller, and we're going back in time a little here to looking at US equity returns since 1871. And if you look over in the left-hand two columns, you can see the really bad years, the years where equity returns, real equity returns, were minus 20% or worse. If you look over more to the right, you'll see a whole lot of blue boxes, and those blue boxes are the boxes that followed the bad years. And those of you who are quick at counting will realize that there aren't enough blue boxes. Now, what does that mean? Well, think about what happened after 1973. It's not a difficult question. 1974, and that's still over there on the left. Think about what happened after 1930, 1931, again still over on the left. This time last year, it was looking for a moment as if 2009 was going to work out to be another terrible year. Turned out to be different, turned out we had a nice recovery. But there's no guarantee that just because you've had one bad year that you don't get another. Let's go back a little further. The Bank of England was founded in 1694, so I've got UK equity returns, excluding dividends, going back to 1693. Now, the period on the right, the bit not encircled in red, is where all of our finance theory, all of our experience, for those of us who are very, very old, all of our experience was earned on that right-hand corner. But for literally hundreds of years before, there was effectively no net real return from equities. So do we necessarily always want that equity market exposure? Now, you may have seen graphs of this type. There's an awful lot of people who say that actually you shouldn't, it's about time in the market that matters. You shouldn't try and time the market. So to demonstrate that point, what they've done is to take the S&P 500 index, shown here in dark blue, and to take out of it just the 10 best days. And to say, well, now look how much of a return you would have missed. And of course, nobody can pick when those 10 best days would be. But also, I don't know anybody who runs a one-day asset allocation process. So let's try another one. What about if we retreat from the equity market 100 days before one of those great days and don't go back in until 100 days after? Well, what happens then is you turn the graph completely on its head. Now, I'm not suggesting that that's a sensible way of managing money either, but all I'm saying is don't be seduced by the graph on the left to believe that you shouldn't think about whether you want to be in a market or not. There's a real question that we have to ask ourselves about whether, in fact, we should be making judgments about whether we want exposure to markets. So this is what goes on in our current world today. It's a sort of very level field. People go out and do strategic asset allocation studies, and the answer is almost always the same, or almost. You know, it changes at the margin. But asset allocation structures are incredibly static. And yet the world that we live in has been amazingly dynamic. Do you not think that it is completely extraordinary that in a decade when we saw asset prices move in such a roller coaster path as we have done over the last 10 years, that institutional asset allocation structures barely changed at all? I think that's extraordinary. And this is why. This is what we've been doing. We go and do an asset allocation study, and the output of that is some kind of strategic benchmark, some kind of normal portfolio. So then we come up with an implementation around that. We decide we're going to do bits of it passive, bits of it active. We go and look for a whole bunch of fund managers. We give them the money, and we monitor their results. And then we repeat it every 3 to 5 years. If that sounds sensible, I want to put it to you, it's as sensible as the Flat Earth Society. And here's why. We've got the 80-20 rule completely around the wrong way. We're spending the majority of our governance budget controlling risks to the strategic benchmark that fell out of the asset allocation study, and those risks are generally small. And we only intermittently manage the risks from the benchmark to the liabilities we're actually trying to pay, pensions, insurance claims, and those are the large risks. And worse than that, the forecasted returns we used in our strategic asset allocation study were virtually useless. We wrapped ourselves around with a comfort blanket which had very little value to us at all. And here's why. I've chosen US equities here first. I'll move on to UK bonds in a moment. The numbers on the left, the forecast numbers, are the kind of numbers you would have used if you'd been running a strategic asset allocation process at the beginning of all of those decades. The numbers on the right are what you actually earned. So in every single decade, the forecast was way away from the outcome. In the first and the last decades, the forecasts were hopelessly optimistic. In the middle 2 decades, they were hopelessly pessimistic. If you really had a 40-year investment horizon, you'd have been just fine. Same thing if you look at bonds. It turns out, no real surprise here, that the 10-year bond yield today is a very good forecast of the 10-year nominal return that you will earn from bonds over the next 10 years. Why? Because there's only a little bit of reinvestment risk in there. But in terms of the real return that you will earn, once again, there are huge error terms out there. Why? Because in every single decade, we've had massive inflation surprise. Now, this process that we engage in today, where we have these virtually static asset allocations, is tantamount to saying that our risk appetite doesn't change as our wealth changes, or that it also doesn't change as forecasted returns change. The first is unlikely, the second is crazy. The moment you start thinking about risk appetite in a more dynamic sense, you begin to have to think about what is going to drive your risk appetite. Is it going to be your wealth, or is it going to be future returns? Because it turns out there's an inverse relationship between the two. When things like equities outperform things like bonds, you tend to get rich. But when they do that by a wide enough margin, future returns tend to decline. So what's going to govern your risk appetite? I would suggest that's going to be dictated by things like the regulatory environment you're in. Are you an insurance company? Are you a pension fund? And things like the strength of the covenant with the sponsor behind the ultimate fund. Now, we've all dodged the issue of forecasting returns over anything other than periods to infinity. So the kind of return you plug into an asset allocation forecast is something like the Gordon model, which basically says that the return from equities will be the dividend yield today plus the long-run trend rate of growth. And because you're going to own equities to infinity, you can ignore valuation effects, and that makes life real nice and easy. Well, John Bogle of Vanguard fame wrote a paper all the way back in 1991 where he said actually valuation effects really matter, even over periods as long as 10 years, as you just saw. So maybe we ought to think about whether we can say anything about that valuation effect. And actually, he took a very simple approach, hence the title of his paper, Occam's Razor, and he basically said, let's just assume that over 10 years, the price-earnings multiple on equities returns to its 30-year average. And if you do that, you get a much, much better fit. A much, much better fit. Notice if you look over at the right-hand corner that actually, if you follow this forecast out today, it's forecasting for the next 10 years. I like forecasts which go beyond my retirement date. For the next 10 years, it's forecasting a rather healthy return from equities compared to the horrible experience of the last decade. Now, whether you have a good experience in things like equities or not really depends upon whether you hold them during a period when price earnings multiples expand or whether they contract. I think there's quite a lot we can say about that. This isn't an exhaustive list, but maybe inflation and interest rates has an impact. I'll come back to that one. Things like a higher or lower perceived growth potential. Remember that G number in the Gordon model, it's still there. And that's rather relevant if you want to think about the credit crisis, because our view, at least, is that the long-run trend rate of growth of the developed world economies has been pretty much permanently damaged by maybe 0.5% per annum. And that's because of damage to the capital formation process. Changing accounting standards can fiddle with the E without changing the reality. You can move the value between the equity and the bondholder. That can have an impact. And then there's this reversion to the mean, which is what we were just looking at with John Bogle's paper.